Hello, everyone. Thank you for joining us today for a special session, actually, of Indie Insights from Management One. If you're not familiar with what we've been doing with Indie Insights for, gosh, I'm guessing since January now, Mark. This is our weekly forum for independent retailer knowledge and wisdom directly from Management One co-founder Marc Weiss, who joins us on the call today. And Mark is joined by Josh Levine and Ari Fishman of Telemus Capital. And they're going to be speaking about retail succession planning, when, why, and how to prepare. But before we get into the actual content that we want to go through, just a couple of housekeeping items to share with folks as people are coming in off the waiting room. The first of which being question and answer. So we are going to reserve a little bit of time at the end of this session to go over some Q&A. Feel free at the bottom of your Zoom panel there to use the Q&A button, and we'll address those questions typically towards the end, but we may insert a few if they're relevant to the conversation at that time. The biggest question that we get is, are we recording this? 100% yes. So we understand independent retailers are extremely busy, and if you do need to take off a little early, or if you're unable to see us live here, we're going to send a recording out to all of our registrants. So no worries there. With that being said, I will turn it over to Marc Weiss to introduce a little bit about what Management One is all about. Thank you, Mark.
Well, thank you so much, Nico, and hello, everybody. It's nice to be here today. I just want to go over the core values of Management One, having a generous heart, courage, curiosity, adaptability, commitment, and collaboration. And certainly a lot of those values are important to you as you think about your journey in selling your business. The core purpose of Management One is to provide financial security for their people, their clients, and the retail experts. And the focus, of course, is on merchandise intelligence and education for independent retailers. Since I sold the business last year, I've continued the educational part of it, which is something I enjoy doing through the Indie Insights. I'd just like to say, if any of you have any topics you'd like to have covered, or ever have any questions, you can always reach out. There's a link on every Friday's edition. I know we're a little early in the week, but we're doing this Wednesday instead of Friday. I wanted to everybody's journey for selling their business starts somewhere. Mine actually started in a hospital room when I had Legionnaire's disease, and it was a Saturday night and things weren't looking good. And I was thinking, oh my goodness, I still have the rest of my life. If I get another chance, what am I going to do with it? And I was very fortunate and decided, the day after I got out of the hospital, to really in earnest begin my journey. And that included a host of professionals that helped. Along with my attorneys and accountants, I also had the benefit of working with Josh and his team at Telemus. They were invaluable to me in every part of it, both the personal side and the business side of it. And you thought it would be a good idea to talk a little bit about your journey in your business. Many of you are founders or entrepreneurs in your own businesses, and understanding what it means to be in business and to have an exit plan is important. And we're going to talk about why and how to prepare for that today. So welcome, Josh and Ari. I'm glad to have you here. We're going to start with the next slide. Why are we here? And we're here to talk exactly about, what it is that you can do to prepare yourself for that eventual exit, whether it's today, whether it's in the near future or long range. It's never too late to start. Josh, I'm going to ask you to open up. What are we going to provide? What are we going to talk about more specifically today?
Sure. Thanks, Mark. I'm really happy to be here. So, why are we here? Well, the thing is, as Mark mentioned, when you are, whether you're starting a business, whether you're getting ready to retire, or really somewhere in between, you always really need to be thinking about what is your exit plan, and what that means for everyone is going to be different. But at the end of the day, you need to have an end in mind. And so, what we're going to talk about, we're going to provide some, a lot of information ideas and tools that you should be thinking about when you're considering your options at various stages of your ownership journey. And we're also going to help you, figure out how to use it. You know, if you can take away 1 to 2 good ideas, that we bring to the table today, we'll consider that a success.
Right. It's interesting. There's so many things I wish I had known before I sold. I mean, there's a lot of things that I learned in the process, which we're going to share a little bit today. But also in that preparation side, I was very strategic about the whole thing. And being strategic is important. And maybe, Ari, you could talk a little bit about some of the strategies that you think about when you're talking to owners about selling their business.
Thanks, Mark. Really appreciate it. Yeah, I think it starts with just the very basics as far as your operations of business. Things that you would want to do for today have a very big impact in the future. So in terms of planning your business to exit, it really starts with the infrastructure and understanding your business, the data that applies to the business, how your earnings are made up, what your revenue lines, your expenses, your unimportant expenses, really getting into the weeds of the data of your business and your people as well. Who does what? Is every single person in the firm, in a sense, replaceable? If anyone in the firm got hit by a bus, is there a backup plan for someone to take up those responsibilities? Anyone in the future who wanted to buy a business would want to know that the infrastructure is there, that the business is going to be strong and solid, based on awareness of how the business is run, that it's not wasting money on inefficiencies, and it's set up with growth and contingencies.
If I could talk a little bit about that, those are really critical, important things to think about, because your strategy is based on what your current situation is today. Even if it's a long-term plan or a short-term plan, you still need to get certain things, your house in order in the right ways. And for me, for example, I decided to implement a business process called EOS. And that really started with getting the right people in the right seat, knowing that the business would be more valuable if I wasn't that important to the business. So everything that I did was trying to replace myself to make sure that the business was engineered structurally so that I didn't have to be there. So when you talk about doing a situational analysis of your business, what does that look like? How do you go about doing that? And I think maybe we could move on to the next slide to get a little deeper into that.
Yeah, and what we're talking about as far as the situational analysis. So you have to figure out what is that ultimate end game from the standpoint of, are you you're obviously looking to build value and growth, but is it a situation where it's just build maximum value and walk away? Do you have people in the business that you would like to continue your vision with? Is it a family business, multi-generation? Is that something important to you? And so, those are all various situations that you need to figure out. But it all starts with, your business strategy plan. So you have to have your strategic plan built, but then it would be foolish to do that without figuring out your own personal strategic plan, right? Because especially if in most cases, the business is going to be the majority of an owner's net worth, and so at the end of the day, you have to build for the future. And so you have to figure out what is it going to take for you to be able to walk away on the personal side, and that is very much intertwined with your business plan. But those things must be done together and with each other in mind.
Right. That, and actually, my recommendation is start with the business strategic plan first, because, if you're going to retire or you're going to walk away from the business and do something else, you need to know, how much money do I need to live? What's my income need? And so having that personal plan is critical, because that gives you peace of mind, and it also answers a lot of questions. How much you spend now, how much do you expect to spend in the year? And one of the things that Josh and his team just did a great job laying out for me was, Carol's and my needs in our future once we retire. And knowing that number allows you to then go back and think about what you have to do with your business to get it to the number it needs to get to turn it over, to sell it, to do any of the variety of options you may have in front of you. But that'll help address some of where you need to go. It'll also help you address the business plan you need to implement.
Right, absolutely. And like we had mentioned, if you look, on the screen here, when you see exit plan, so we have M&A, that would be a merger or an acquisition, with another company. Is it just a third party outright sale? Is it an ESOP? That's where you sell the company back to the employees. That could be a possibility depending on what your objective is, or again, keeping it within the family. And all of these have, there's various implications on total value. There's tax implications, estate planning implications, so really you don't want to be doing this in a vacuum. You want to do it with your professionals that you have both within your business, but then those outside advisors, like Mark had mentioned, your CPAs, your attorneys, financial advisors, etc.
Yeah, so there's lots of options there too, because I was talking to an owner just recently, and this way we go on to the next slide, I think. I was talking to a business owner recently who's looking, actually it's my brother-in-law who's looking to sell his business. And I said, Greg, didn't you buy the franchise from somebody? And he said, yeah. And I said, well, you may have tax equity built up where, that you can use when you sell the business. So, putting the right pieces together in your own business structurally, we talked about what you should do personally, but you want to have the right business entity together. So what kind of corporation you are, what kind of, that's part of your situation analysis. I didn't know, for example, that if I was a C Corp and was a 1202 QSBS, when I sold the business, I could have avoided paying capital gains taxes. I mean, nobody would think that. Almost sounds too good to be true, but it's a true thing. So there are elements of what you need to do to get yourself into position when you sell your business. And maybe you could address some of those other things that you should be aware of.
Yeah, absolutely.
Yeah, I think we want to go to the next slide.
Go to the next slide. Yeah. And so, like we'd mentioned, the succession planning internally versus externally, but something very important to consider is whether or not you're going to be undergoing an asset sale or a stock sale. So if you think about an asset sale, it's basically the purchase of individual assets and liabilities. Whereas a stock sale, you're purchasing an owner's stock, and why that's significant is because it's a very meaningful difference in tax treatment. Now there are a lot of different factors, but in the simplest sense, a stock sale, you're basically looking at the growth at capital gains treatment, which is going to be much more favorable than on the asset sale side, when you're considering stock at ordinary income levels. So it's a big difference. And then Mark had also mentioned, when you're thinking about the structure, whether it's an LLC, an S Corp, a C Corp, all of that has to be considered as well for tax treatment. But what you also need to consider is whatever structure you started with, when you set up your business, is not necessarily going to be the structure that you exit at. And so that's why it's very important to be thinking about your strategy well in advance, so that if you do need to change structures, you can do that in the appropriate time frame, to be able to take advantage of those very meaningful tax implications.
Right, and some of those can take years. Like some of the corporations that you need to file for, they need to be approved. That could take, you may have to be under that auspices for up to 5 years. So, pre-planning for that, and then also looking at your current tax situation, something you really want to do a deep dive with your accountant and with your financial people.
Absolutely.
Right. So, okay, so we're moving on to the next slide. Thank you. So we've laid out a couple of different scenarios here. What to look at ownership, what to look at family goals, and also what the business plan needs to look like. So, when we're looking at a transition plan, you have to weigh the opportunities that are out there, what you internally can do, and put a timeline in place for yourself with milestones of what you'd like to achieve when you'd like to achieve them, and how you're going to get there. And by the way, all of those are important because it helps you think through the process and make adjustments. And I also found it gives you a guideline to follow, so you don't put yourself under enormous pressure too, because sometimes market conditions can change, and sometimes it's a little bit more opportunistic than other times. So if you could just speak to those a little bit, that would be great.
Yeah, I could speak to some of these components in terms of overall structure, and we talked about this from an operational perspective, everyone kind of knowing their role and that they're replaceable. But it also, this goes into just making sure that your house is in order from an insurance and benefits perspective as well. If you have key people that are very difficult to replace, then they're worth of value, and there's insurance to be purchased for them. That would matter in the future. If your ownership is shared with others via some sort of partnership relationship, again, there would be some buy-sell components to provide the liquidity there. And these are things that are not just important for your business today, but these are important for any potential buyer to want to know that the business is set up with appropriate contingencies if things go off unplanned. So that's really important. And even just from a very basic review of employee benefit plans, as an example, if you could save 10% on your benefits without cutting costs, guess what? When you go out to sell your business, there's a multiple on that. So all these little things of just figuring out what expenses should be in place for contingencies and where you may be able to save money without necessarily cutting costs, without cutting benefits, actually has a multiplier effect, not just for today's earnings, but if you end up selling sometime in the future.
Right, and one thing I'll also add, when you're thinking about those benefits and retirement plans, there's, like Ari had mentioned, there's creative ways and protective ways through the use of insurance, but also with your retirement plans, if retaining key people is going to be a very important part of your transition. There are retirement plans where you're able to put away a lot of extra money on a tax deferred basis, so saving yourself on taxes, but also building up a pot for that employee base or for those key employees that you need to take on when you're finished. I know, Mark, you've mentioned plenty of times in the past you wanted to get the business to the point of where you are irrelevant, and so that's very important when you need to retain key people to make sure you can be irrelevant.
And we talked about this a little bit earlier. Mark talked about it with Josh a little bit about the personal planning, and that's as far as comes back to knowing your number as far as what you would need to retire on, which ultimately has a direct impact of what you may need to sell the business for. So you could work on strategically to grow your business to a minimum at that point, and hopefully obviously get more within the market conditions. And then your family objectives as far as structuring some estate planning, just like business entities, trusts or things of that nature should be coordinated depending on the value of your net worth pre and post sale.
So could you both talk a little bit about EBITDA? Because I think a lot of people, when you're looking to value a business, that question comes up a lot. One of the most some of the most asked questions I've ever gotten is, what's the value of my business and how much can I sell it for? And one of the defining numbers is really EBITDA. At the end of the day, it's really what you can get for your business, regardless of EBITDA. But if you could talk a little bit about that and a multiplier and what that means and how you can, and that's why data and analytics and having your financials in place is a smart thing to do. But if you can talk a little bit about what that means in the marketplace, because for some people it's a confusing
item. Sure.
Acronym. Is that the right word?
Yeah.
Acronym?
Yeah, absolutely. So EBITDA, earnings before income, tax, depreciation, amortization, it's really the measure of profitability of your company. And
Right.
so, when you're thinking about going out to market, that's going to be, one of the most important, metrics, we talked about data earlier, that outside companies are going to be looking at. Some will look at maybe just top line sales, and maybe there's a small multiple on that. But, we all know if the business isn't operating very efficiently, then that kind of is a little bit irrelevant. So, those EBITDA numbers are very important. And so, the multiples are going to be attached directly to that. And, what companies want to see when they're looking to acquire is that's a healthy number, but more importantly, that's a number that they can continue to grow and expand on. So it's very important to have a good handle on what your EBITDA, what your profitability of your company is, and what the prospects are for the future for that.
Yeah, and depending on how the buyer is going to invest in your company, is it going to be cash? Are they going to borrow the money? Are they going to have investors? The strength of your EBITDA also gives them the power to be able to finance the enterprise they're looking to buy, right?
That's absolutely right.
Right. So EBITDA is important, and having your financials in place are important. And if you're going to do any kind of third party, there are talk about some of the resources that are also available. There's obviously there's your accountant, there are attorneys, M&A attorneys that are available, but
Right.
There's also other resources available too. And I know I'm assigned with one, so I'm familiar with some other resources. But if you could talk a little bit about investment bankers and those kinds of things, even for companies that aren't large, this is geared for small businesses. So there are professionals that are available no matter what size your business is.
Right. Yeah. And that's a very good point, Mark. It's there when you're thinking about the exit, the question is, all right, well, so how do I make my company available and known, and how do I know what it's really worth? And so all of those professionals you mentioned can help you, to some extent, but you really, there's a few different categories. I would say investment bankers, the investment banking community is very important to businesses, because they have a pulse on the industry and what's available and what businesses are selling for. And it's a expensive service, so to speak, but quite frankly, when you're in probably the biggest transaction of your life, that's what you want. You pay for what you get, and so you get great expertise, not just on what your business is potentially worth, but who are the potential suitors, that match up with what your end goals are. Now, there are also business brokers, and a lot of these are interchangeable. Business brokers and market brokers are very valuable as well to get your company out there to find potential suitors. Typically, they deal with smaller transactions, so there may not be as much consultative information or help or assistance, as you would maybe with a more comprehensive structure with the investment bankers. But business brokers are also a great resource, as an outlet to figure out what's available. And so when you're going through this, you want to have your trusted advisors, but you really do want to make sure that you contract with an outside advisor, whether it's an investment banker or business broker, to figure out, what the true value and what's available for your firm.
Yeah, and I think when you're looking for outside advisors, it's good to have a list of questions that you want to ask about, because you want to know what you want to know what arrangement you're going to get involved with, and knowing that up front is important. And what are they going to provide for you, and what do their references look like, and so I think spending some time thinking through what those questions might look like and what you're going to achieve from that would be important for you to understand. And what their agreements look like too. So I was almost going to go with an investment banker. They were going to spend just 5 or 6 months putting, the business in place so that there would be multiple suitors. It wasn't the path that I ended up going down, but there are multiple paths. So another thing to think about when you're creating your journey is be flexible as you go through it, and be open to learning and understanding the process as you go through it. And one of the things that has served me well in my life is reaching out and talking to lots of people about whatever subject I'm interested in, because the more you learn, there's a lot of people out there willing to give you a lot of information. and so that you can end up making the right decision for yourself with the people that you want to work with. One of the benefits of working with a company like Management One is the availability of those resources, but also if you're a retailer on this, making sure that your financial plan and your break evens are all are put together and tight, so you're buttoned up when you decide to make that move. So we want to talk about some best practices here. I kind of started to dovetail into it, but we talked a little bit about identifying future services. Is there anything else you would add to that, Ari and Josh? I mean, Ari, you talked about insurance. You might have compensation plans in place with certain key executives. You really need to know and understand what the consequences of those might be, so that having good professional people to help you put those kinds of things together are critical.
One thing that I would add is also, you talked about having a lot of conversations, and this is critical because before you would potentially even hire a investment banker or a business broker, just by having these conversations with them, your and trusted advisors, you'll get a pulse very likely of what your business value is before spending a dime. And that's helpful. And you'll also get a pulse of, what would make it more valuable just informally. So that could kind of help get you set up before you even engage in that type of process. So having a lot of conversations is always best practices, even, and especially with people who have sold successfully. They've always will have reflection as far as best practices, what they would have done differently and what they did right.
And the other thing I'll add too is the reason it's important to have the multiple conversations is, and going back to why the financial plan is so important, is because if you determine that your final number is whatever it is, and through a process, maybe not going outside, to the investment bankers or in other cases, you find a potential suitor, you like each other, you have found that the number, is appropriate for what, your goals are, that may be sufficient. Again, it gets to what are your goals? Are your goals just to maximize value, or are there a lot of other things that are involved? And that's why really having that plan is the most important to kind of work through what the best situation will be.
Well, I just want to say that's I'm sorry, Ari, but there's we had just had a client sell their business, and what was important to them wasn't the financial aspect, it was the legacy of the business, which was surprising to me, but they were in a position where that wasn't the most important thing. They had spent a career building a name, a reputation, a business, and they wanted to see the survivability of that. So, who they sold it to and, the transition plan and everything were extremely well thought out. So understanding what is important to you is part of the process too. I'm sorry, Ari.
No, I appreciate that as well. One thing I'll add to this is thinking about your exit plan is really just thinking about today from a growth mindset and growth operation perspective, where you could add revenue lines, where you could add synergies, where you could cut expenses, where you could just understanding, knowing, and having that growth mindset is good for your business today and in the future. So that's really important. And then the legacy perspective, that resonates with me really well. It's very hard to build the business in our space, and when you do, it's really amazing, and the engine's running. And personally, I would love it if my kids came into the business and were able to walk into it, as long as they just didn't mess it up and have a very nice livelihood. That sounds wonderful to me. So everything, it's different objectives for any individual person.
Right. So we also talk about select training and development activities. I talked a little bit about EOS. If you haven't read the book, Get a Grip or Traction, it's a good book to talk about your business. All businesses, hit the same 5 issues that they talk about in there, and there are ways to address them, the strategies and tactics you can employ. So never think that there aren't ways of doing things. If you're an owner of a business, the most important thing that you could probably leave here is thinking about, what is it going to look like for me to let go? And that is the first thing that you really need to address. And then just to build a little bit on what Ari just said, this whole process of this exiting your business or your succession planning makes your business much healthier. You might in turn see your business start to thrive in a way you hadn't anticipated and decide to postpone that. So only good things can happen from going through this process. So it is way more than just exit planning, and it really goes into other aspects. So you could go on to the next slide, please. So sales strategies and planning, if we could flip through the next one then. So there's obviously all of these things, the planning and research, which we touched upon. Raise your profile. That's an interesting item to talk about.
Yeah, absolutely. No, raising your profile. So, this is there's a couple pieces to this. Number one, it's also ties into, kind of getting your house in order. So on the one hand, you could be operating just to, maybe stay above water and then grow and then continue to be profitable. But then when you start to think about how do I position this to exit, well, you're going to have to make sure people know about you. So there's kind of the maybe traditional marketing that you could do on your own, but until you engage some outside help, outside advisors, you can't really fully raise that profile. So I know we talked about the other professionals, whether it's the business brokers or the investment bankers, but I would also say, if you're holding, whether you do conferences internally or externally, your marketing, various webinars, those are also ways to showcase your business. But if it's specifically geared towards raising the profile to get sold, then that's where you have to enlist the outside advisors, be my opinion.
Right. So, and I think a question that might come to mind for some owners is, well, I'm interested in selling my business, but I don't want my people to know because I don't want them to lead. So that can be a tricky part of the equation too.
Yeah, absolutely. And in our experience, with clients of ours that have looked at selling their business, or at least getting inquiries, that first introduction or the first couple introductions with those outside advisors are really just with the owners and the companies. And the companies are able to do plenty of things in the background within their network that really doesn't even come close to what's going on with the owners day to day and their employees, until they're able to get a full range of information, so to make a decision going forward.
So raise your profile, enhance your value both monetarily, you're getting your EBITDA up, and it's good to know what your EBITDA is so that you've got a benchmark to think about ways in which you can increase it, right? And then there's the deal time, and that can be short or long, right?
Oh yeah. I mean, like they say, that the devil's in the details. I mean, there's plenty of situations where you have the term sheets or the LOI signed, but getting through the nitty gritty with the deals, that's extremely important. That's where you're bringing in all of your advisors. You have to look at the tax implications. You need the attorneys, various attorneys. Make sure it builds in with your financial plan. But then all of the specifics that are important to you regarding your business, regarding your legacy. If you're selling and walking away, maybe that's one thing. But if you're selling and you've got people that you want to take care of, and you want to see business run a certain way, all of that has to be built in and addressed during the deal negotiations.
Right, and then there's the whole transition. Actually, when I was thinking about what I was going to do post sale, I was thinking if I was going to write a book, it would be on the transition, because I put so much thought and effort into the transition and what that would look like for myself, for the new owner, for the team, how the introductions went, how the turnover went. That in itself was a full-time job. And so that's another thing to think about when you're selling the business. There's all the prep work. I mean, all of this falls to you as the owner, right? So it does require you to step outside of what you normally do so that you have the time and space to manage the process and use your people effectively. One of the first person I told was the president of the company, because Mike was so integral in the process of transitioning and helping me provide the information and thinking through all the decisions that had to be made. So in each one of these phases, you as the owner have a lot to do and a lot to accomplish and a lot of strategies and thoughts. So the more you surround yourself with, and you're going to surround yourself with good people, but at the end of the day, you're going to make the decision on what's best for you and your business. They say when it comes to your own personal health, nobody knows you better than yourself, and nobody knows your business better than you. Nobody can speak to raising its value, raising the profile, understanding you built it from the ground up. So you're in the best position as the owner to be able to do all those things, which is why it's so critical that you have people who are working in the business every day so you can work on the business to make these things happen. And getting yourself to that point will allow you to get to the point where you can sell it.
And Mark, it's you mentioned it, and it's so important because what we've also seen is, when you talk about transition, just because you're selling, and even if the buyer, I don't care how confident they are or comfortable in the business, they're not going to know your business. And so if you want things to go a certain way, you can't assume that they have the answers for you. You have to make sure that you are proactive in letting them know about how certain things should run. I know you have a plan on transition here, but this is kind of what I would think. And so, yes, building in that process and have plenty of time to transition, especially if it's one of your goals, is going to be critical, to a successful handoff.
Right. Yeah. One of the things that I was so surprised at was the amount of options I really had. And, I think a lot of times people think they have certain things you might think about your business and you might feel you're very limited. And yet when you really start to engage in the whole process, you'll find out that the options that are available to you are broader and the spectrum is bigger than what you might have thought of to begin with. And so, but you have to be willing to do the work like anything else.
Right.
All right. On any of these, Ari, any other gems or that you want to add to?
No, I mean, these are all great and critical points. Nothing right from those points.
We're going to recap and then go to some questions, right? So planning for the exit, consult with board and other partners. I also belong to a peer-to-peer network. They were amazingly helpful in turning me on to people that were extremely helpful. I didn't use them all, but they really gave me a lot of good ideas. And so, seeking outside help is important. Who wants out, who wants to stay in a post-acquisition? This is a critical question. And then find a broker or transactional lawyer and start talking. And again, if anybody wants to go deeper into these, we're certainly, we're all available to answer your questions. I mean, when I interviewed 3 law firms. Fortunately, I have a son-in-law that's an attorney, so he was great about participating with me and helping me write the questions. So I made the best decision for myself. Determining your company's worth. I think this is the number one question everybody's going to ask. How do I know how valuable my company is? And, do you need an independent appraiser? What factors can you control to enhance it? Start with understanding your EBITDA and then have discussions with, outside sources that can help you.
Right. And when you're thinking about, what that company worth is, right? I mean, it's very difficult to do that on your own, right? Because you only have so much information. But what you can do and what you do know is your profitability, how much money you are taking from the firm, to live off of. And so, that's why it's very important to think about what is my company worth, but what does my company need to be worth in order for me to be able to step away.
Now, something's come up to me in my life a couple of times, and the first one was when my wife and I sold our first home in Cleveland, and I remember the realtor asking, "What's your happy price?" And then when I bought the business from my partner, Evan, what was his? We sat down at a breakfast, and I said, "Well, what's your happy price? What is it that what is it that you can walk away from feeling like it was a good deal?" For you, and something that'll work for me as well. And we worked from there. And then when I sold the business, Evan actually asked me, "Well, when are you going to retire? What's your happy price?" And that was evermost on my mind, because I was looking to leave because of what I said earlier. When I was in the hospital. So know what that happy number is for you. That's an important number, and because that's the number that when the transaction's done, you've got to be comfortable with. Because you can't look back and say, "I wish I'd done this, I wish I had done that." So getting that number right in your mind that you're happy with can be is very consequential.
And that's why Mark, it's so important that it has to fit in with your goals, because it's not just about the highest possible number, because it's almost impossible. You never know, right, what that highest possible is. So but it is, what is that number that's going to make you happy and that you're going to be able to live with, like you mentioned.
Okay, next slide. Okay, we talked about raise your profile, and I think there's some good thoughts here. And milestones is a critical word in whatever project you're doing. And it's hard to do, but lay out those milestones, and find firms that, and outside sources that can help you, and then build financial strength. I mean, if you build financial strength in your company, that says a lot about you and your business. And there are all kinds of stops along the way for you to be able to do that. And I think sometimes business owners are overly thoughtful about the economy and how the economy shapes and how their business responds. And I think it's how you control your business and how you manage it to take advantage of any economy that's important. And how to make, how do I succeed when if we're in a recession, or we're returning to a very normal phase in business right now. Matter of fact, my blog in the community newsletter is all about that. It'll come out before the end of the month. So in any economy, you have the ability to build and create financial strength in your business. And this is what you tell me all the time with my personal finances, Josh, right? There's always options to do things to get a return on investment.
And these things are really, really important when you have multiple ranges, a multiple range for various types of businesses. The profile, your brand, your diversification of revenue, your long-term expenses and or liabilities, your debt, all these things. If the better they're in order, the more on the upside of that range you're going to be.
Right. I say the last one, clean up any overdependency on any one supplier or customer. And I think if you're a retailer, unless you're a mono brand, it's important that you not be overly dependent on one vendor, because that could destroy your business, or have one customer who represents too much of your business.
Right, and that absolutely is something that companies are looking for, and that's a question that's always asked. What's your concentration risk? Because even when you're looking to unwind, it's the old adage. I mean, if you're not growing, you're dying. And so you have to continue to be growing, and companies that are looking to purchase have to see that growth possibility.
Okay, I know we want to save some time for questions, so we'll flip through the rest of these. I think we've kind of touched on them. But get your house in order. We talked a lot about that. Outreach is important. Buyer outreach. is important. Certainly seek help, and there's opportunities to do that. There are professional people who do that. These are timelines. And this is recorded, so this PowerPoint will be available to you. And then the deal, how you structure the deal, that be very thoughtful about that, and be prepared for a lot of due diligence. So when you're preparing your business, also be preparing for the due diligence, because it can in some ways be an overwhelming process. So if you get your financial house in order and all your financials are up to date and they're in good shape, then that helps a lot, because that's where it all starts. And then a letter of intent really in any deal is what gets the whole ball rolling. So make sure you don't do that on your own. You have an attorney involved with that. And the post-deal transition is critical, in every aspect, both for you personally, because your life's going to change, and also for the business that you build. So as I said earlier, the transition part for me was almost a book in and of itself. Any final thoughts before we turn it over to questions?
Yeah, you know what? Listen, it's preparation. I mean, like anything else, it's preparation. It's thinking ahead, and it's combining with with smart advisors and a good team. And the other thing I would say too is, and Mark, you alluded to it. There's that time period, where you want to go out to try to solicit interest in your business, but you also don't want to upset what's going on at the office. And so to the extent that you can get your people involved and be upfront with them on what's happening, the earlier the better, obviously to help with that whole process and then the transition.
Nico, do we
Excellent.
have any questions?
So before we go to questions, the folks at Telemus have kindly arranged a bunch of resources to go along with this presentation as well. There is a QR code up on the screen, and in chat, I'm going to go ahead and put the link that applies to that QR code, and we'll include that in a follow-up email as well. So we're encouraging folks to go there and just grab some of those free resources that the folks at Telemus thankfully put together for us. And questions. So our first question, go ahead.
Oh, no, I was just going to say, Nico, I see a bunch.
Yes, we do have a lot. So I'll kind of start at the top here. I know the acronym EBITDA came about a couple of times. Becky Kingston is asking, the EBITDA multiple, is there a difference between online retail versus brick and mortar? Is there a target, I guess, that you should be looking for based on the two?
Yeah, I mean, the short answer is, it really depends. It depends on the profitabilities of the companies and the outlook for growth. There isn't necessarily a specific value or multiple associated with bricks and mortar versus online. It really just has to do with what are the growth potentials of the business.
One of the things that
Mark and also how the business is trending. Is the EBITDA rising or is the EBITDA falling? And why is it rising or why is it falling? And then being able to adjust or pivot your strategy to build on that.
In those areas, I also think the long-term contracts, if for retail, for example, if you're in a long-term lease that's under or above market cost, that is an impact. So as you're thinking about getting closer to that time frame, looking at those long-term contracts, it becomes very important as well in terms of valuation.
Yeah, I also think if you're like in an e-commerce, what's your infrastructure look like? What do your fulfillment costs look like? There's, if you're growing, what are your trigger points? What's your capacity, right? Because that's important in e-commerce. So, and to Ari's point, what do your lease or leases look like? That's critical too. So getting with your landlord is important too. Can you sell your business and turn the lease over to somebody else? Are you still going to be responsible for the lease? So, checking all those boxes is part of the process.
So a follow-up question there from John Adams, M1 retail expert. He's asking, if you're a retailer looking to sell and you know what your EBITDA is, what factor is normally used to determine the selling price?
So that would be the multiplier, and that's going to vary from deal to deal. I mean, part of it goes into, what's your happy price, and does the multiplier make sense for that happy price? What does your personal situation look like? So I think all the things that we talked about go into that. You're asking if there's a rule of thumb. It just depends on I hate to use the word it depends on, but every situation is a little different. Every situation is a little unique. And you could dominate your market share, which would make your EBITDA more attractive. You may have a long-term lease that's at below market value that would make your EBITDA more attractive, which would raise the multiplier. So I think you really need to look at each factor that goes into the profile of your business that we talked about before, and determine what the EBITDA might be. You might have a tremendous, you might have a high return rate of customers. You may have a great marketing program. It might be things that you've built into your business that give a new buyer assurance that the ongoing value of the business will sustain and build and grow, because somebody looking to buy your business is looking to look at its assets and how it can grow it to pay themselves back for what they spent for it. So not trying to dodge the question, but the profile of the business is important to that. It could be 3, 5, 10, 15, 20. I mean, the EBITDA could be, the multiplier could be based on a lot of different attributes.
Yeah,
Yeah,
and
go
just, I
on,
mean,
Josh.
Mark kind of touched on it, but just to add, the growth is really important. I mean, when companies are looking to pay a multiple, they're immediately thinking about how quickly can I recapture my investment. They're obviously willing to pay more if they think the growth is higher and the payback period is going to be shorter.
And also acquiring companies are going to look to see if there's other revenue lines that their business may be able to bring in that immediately would drive the bottom line. So who's acquiring the business? One firm may be looking to pay a lot more than another if they feel that they could use the infrastructure of business to drive their business, their revenue sources in their business, and cross sell. And then another thing is, in general, as a general rule, the bigger the business and the more profitable it is, the higher the multiple that someone is willing to pay for the same business.
Right. So, in retail, you might have an e-commerce business is looking to get in the brick and mortar business, and it would be a good buy for them. They might have one or multiple locations that would be good, or you might have a brick and mortar business that's looking to get into e-commerce and selling to a bigger e-commerce entity. So there's all different types of partnerships that could be available and open to you. And by the way, if you're an e-commerce looking to get brick and mortar, the multiple might be higher for the brick and mortar seller because they've already negotiated the leases, they have the people, they have the infrastructure. There's a lot of things in place. The cost of customer acquisition, the cost of growth, the cost of, build out and leasehold improvements, if you can circumvent that, then that raises the multiple.
Excellent. So Kathy actually has, I'm going to set this question up because she provides a little backstory a little later. So Kathy, fortunately, her business, they've already done many of the things that you've suggested in the session today to prepare the business for a third-party sale. They have a women's clothing retail business, 30 years of history. They're in a county in California with a population of about 500,000. But they're 2 hours from the nearest metropolitan area of San Francisco, and they don't really have any contacts in the area in regards to finding a reputable business broker. So how would somebody in a smaller market go about finding a reputable business broker if they're not in one of those major areas?
Well, there's actually a really good business broker within the M1 network, and afterwards, Nico, we could provide that information, and Kathy could reach out to that person.
Yeah, and we're happy also to provide some recommendations too. But Kathy, in general, I mean, the way you go about finding the business broker is leverage your network. First talk to the people that you know and see if they have recommendations. I try to caution against just searching, Googling, best business brokers. I mean, but if you are doing that, probably would recommend LinkedIn first, and then see if you can get as many references as possible. And then if you're able to call some, but start with your existing network, talk to some people that you know first.
Right. And like I said, we can give you the name of one within our network that, we can, that's, is reputable.
Excellent. Michelle is asking, are there typically buyers for single store boutiques? Do you know of any in the last year or so? 1.2 gross sales. I'm assuming that's 1.2 million gross sales.
Yeah, I mean, there are buyers. There was a company this past month that sold. They were clients of, I think, ours for 16 years in California. They sold to one of the people in the business. I mean, it was a long deal, but it worked out well, and everybody, I believe, has walked away happy. So I mean, yes, there are buyers. Remember, there's a lot of money out there that hasn't been invested. I think retailers tend to think about the economy in terms of how their business was last month, but there's a lot of money sitting out there for people who are looking to get into a different business, a different life. So yes, absolutely. But that goes back to answering the question of understanding, raising your profile and getting yourself into a network of finding those people. And through the Manager One network or some of our relationships with some of our other, actually talking to your, good resource is to talk to your vendors, because they often know people who are looking to buy businesses.
Excellent. Let's see. Karen Alberg from MR Magazine. Thanks for joining, Karen. She's asking, how can I encourage retailers without a succession plan to get one? Apparently, many have kids who don't really want a retail career, and a lot of these merchants could already be financially secure. So what's the motivation for getting one?
Well, I think it's just making up your mind you're going to do it, right? And be willing to do the work. I think that a lot of people give things lip service and they talk a lot about it, but they actually don't take the time to hire somebody to help them do it. So I would say the first step is deciding that you want a succession plan, and then starting to do the research on the resources that are available to you to be able to get that done. I think that's important. Just like, to retailers that go to a market to shop for different vendors and new lines, they need to go to market and shop for resources to help you sell your business. And I think, one of the reasons I endorse Telemus and have them on today really is, I think it starts with you individually. You have got to understand your own personal financial situation before you do anything else. That's mission critical, because that gives you a sense of where you need to go in your journey. It gives you a sense of what your peace of mind is, because I think there's a lot of anxiousness and angst that people have about, I've spent my whole life building this business, and if I can't get X number of dollars for, and I haven't created enough wealth in my life, what do I do? Well, it's never too late to start creating wealth in your life, and that's critical and it's important. So I think the first step is to just understand what your own personal needs and your own personal situation is, and then start to build and develop a strategic plan for your business. But that's going to take some work, and they can certainly reach out to me. I'm happy to talk to them. They can reach out to anyone at Management One. They'll help them and, begin that discussion. I've had that discussion with dozens and dozens and dozens of retailers in the last 35 years.
I also think, you mentioned looks like they're financially secure. You're never sure what exactly that means. And, if anything, at least going through or having a discussion validates, what they have, which helps with peace of mind, but it also can uncover many opportunities for more efficiency and really helping them achieve what they want to achieve.
Yeah, and there's been a lot of really creative deals. We didn't really spend a lot of time talking about deals, but I've seen dozens of different relationships and different deals done. So there are always those kinds of opportunities too. And when I think even about, I did a whole seminar for the peer-to-peer group that I'm in, And because the kind of deal I did was, nobody had ever heard about it before. So there's a lot of creativity out there in the marketplace. So again, don't leave yourself too locked into thinking there's only one or two ways to do things, because there could be multiple options available to you.
Excellent.
I hope that answers the question, Karen. If not, you can always pick up the phone and call. Happy to talk.
Well, I would advise that for the next question too. So John Adams, obviously an M1 retail expert. Many of them have very much of a one-man show type of operation. So John was curious about how to determine the value of a practice in order to turn it over. I would absolutely encourage you, John, to reach out to Josh and Ari at Telemus to get that process going.
Yeah, I mean, I think that no matter what kind of business you're in, there's opportunity for you to put yourself in a position to win, and that's what other people do for you. I'd also recommend everybody on this to read The Psychology of Wealth. There's a Psychology of Money. I think that's if there's a book that every business owner should read, it's The Psychology of Money, because it really talks about, even if you make an average income, how you can, I don't mean to say even, if you make an average income, how you can become wealthy. The book is, it should be a handbook. It should be required reading for anybody that goes into business, or anybody that, goes to school should read that book.
Final question here for folks that do have family-owned businesses and they're looking to possibly get a succession plan in place. When is an appropriate age to start that conversation with their children? Or is there one?
That is a great one, by the way.
Are they in the business or not in the business now?
That's a determining factor, I guess, to think about for sure.
Yeah, I mean, if they're not in the business, you maybe want to have them work for somebody else first and then come work for you. But if they're in the business, then I think it's appropriate to have the conversation as soon as possible, because you're going to want to train them up to be able to be in a position to turn it over. I mean, I had that old conversation with my son. He wasn't interested in the business. He wanted to stay in the business and work in it, but didn't necessarily want to own it and run it. So it changed the dynamic of what I did. So if you have somebody that's interested, that's a family member, and you believe that they would be a good successor to the business, then I think the sooner you start that conversation, the better, because you just can prepare them and lay out a timeline and a strategy to start, making that happen. And also, we're not all good at everything we do. So you want to surround yourself with people who are better than you at things that, need to be done in the business, including being better at your own strengths. So the sooner you come to terms with that and recognize that that's important, the sooner those things can happen. But I think if you're going to bring family into the business, you want to understand their strengths and weaknesses, and then start to build a team around that. It's going to be different than you running the business.
Love it. We do have one final one here. I know we're a little bit over time. We'll see if we can address this one really quickly. Melissa's asking, what kind of return is a merger and acquisition firm looking for in a business acquisition, and how quickly is it reasonable for an owner operator to recoup their purchase price?
Yeah, I mean, unfortunately, that also depends. I mean, but I will say, I mean, when M&A firms are looking to purchase, they're looking to get a big return out of their business, especially if it's a private equity firm. So, whatever they buy, they would then be looking to, double or triple, on their investment. I mean, that's definitely not uncommon. And from the owner actually, you as the owner selling, you'd be getting your purchase and then some, hopefully, once you're selling. And as far as the acquirer goes, the M&A firm, they'd be looking to recoup their investment, probably relatively soon, although it does depend, but I've seen, anywhere from, 2 to 4 years.
Yeah, and I think, you know, growth-wise, they're probably looking out 5 years and more, aren't they, Josh, or is that just something in my
Well,
mind?
that's on final exit, but they'd be looking to recoup their investment before that. But yes, you know, the next turnaround may be 5 to 7 years after they've made the purchase.
Excellent. Well, thank you very much for staying a little bit over to all the folks we have on here. And thank you so much to Josh and Ari for providing the insights, and Mark as well for joining us and getting this all together.
And Nico, I just want to, you know, say on behalf of Ari, myself, and Telemus, we're thrilled to partner with Management One, thrilled to be part of Indie Insights. You know, we've really enjoyed working with Management One, and hopefully can do it in the future. And I'll just throw it out there: if there are any questions, just feel free to reach out to us. You know, we're happy to discuss. You know, no matter how big, small, you know, the question is.
Yeah, and there's, you know, when you're getting started, there's lots of free information out there. So don't, you know, I don't know anybody that I've talked to over the last couple of years that, I mean, I was on the phone, you know, started thinking of another business, and I was on the phone with the attorney for an hour and a half, and they didn't charge me anything, which was hard to believe because they're a high-priced law firm. But, you know, there are people out there that are really open to work with you and help you. And in the investigative process, it'll help you answer a lot of questions on the front side. And that's important. You need to have your questions, your concerns, your uneasinesses addressed.
Absolutely. Well, we appreciate, Josh, as well, having partners like Telemus that can provide insights into these areas that here at Management One, we really try to stay in our lane in inventory forecasting and planning. So it's good for our clients and our community as a whole to have access to this information. So we really appreciate you guys joining us today. And I see your email addresses on this slide. I will include those on our follow-up email as well, so folks can reach out directly to you for questions.
Yeah, and if people want to, and you know, reach out to Nico, he'll get to me, and I'm always available to answer any questions. So thank you. Thanks, Nico, for putting this together. Really appreciate it. Thank Management One.
Absolutely.
Yeah, thank you guys.
Thank you.
Well, that'll do it for us today, and we look forward to the next Indie Insights coming up next week, Mark.
Thank you.